expecting more folks to be joining us, but that's fine. I want to be respectful of your time this morning, so welcome. I'm Chris Silva, the president of the Chamber of Commerce, and I want to welcome our speaker today, Jessica Mello from the Seed Corporation. As the Chamber, we are really proud of our relationship with Seed and other resource organizations like Seed that help our small business community to be sustainable, first of all, to get off the ground, and then to be sustainable and successful in what they do. So we're really grateful to have Jessica here for the benefit of our members this morning. So I will turn it over to Jessica.
Thank you. Good morning, everybody. Like Chris said, we are very lucky to have a strong relationship with the Chamber, with other financing partners. The more resources you have at your fingertips, the better, especially if you're in the startup or growth phase of the business and you're just looking to get as much information as possible. I find that can really only help an entrepreneur. So this morning, what we're going to be covering, speaking of financing, is just kind of what to know if you feel like getting a loan is going to be a part of your business journey in the near future or in the distant future, how to have that conversation with the lenders, what lenders are going to look for, and if you are at the point where you know a business plan is important, an important part of that process, what needs to be in that plan to really sell your idea and sell the business. And of course, I will say that if you have any questions, I don't mind if this is, conversational and casual. I think that it's true. If you have a question, very likely somebody else is thinking the same thing. So please don't hesitate to ask. You can put them in the chat or, raise your hand or just unmute and ask. I'm happy to go over anything that you're wondering about, you're wanting more information on. All right. So hopefully everybody can see the PowerPoint. And if you can't, just let me know. But as I said, we're going to just talk about what lenders look for. If you're going for financing, these are the things that you kind of want to be prepared for. Usually, I hear from a lot of business owners, a lot of borrowers, that the thought of just walking into a bank or even picking up the phone, talking to a lender is very intimidating, and it's kind of daunting, especially if it is your first time doing it. But it helps to know what they're expecting of you. So we'll start with the 6 C's of credit. And the 6 C's are very, the rubric is pretty much true for traditional lenders like banks and credit unions and non-traditional lenders like SBA loans, third-party lenders. I typically tell people to kind of stay away from just online lenders. They can be a little predatory. The interest rates can be very high. And it's usually best to talk to your local institutions before going that route. But as I said, this is going to be the rubric for whichever lender that you speak with. The first thing that they'll want to know is the cash flow situation for the business. And cash flow is very simply everything going in versus everything coming out. When I started teaching these workshops about 8 years ago, I would usually ask, does anybody still balance a checkbook? I got laughs then, and I think now nobody really does that, but doing your business cash flow is exactly like balancing your personal finances. You want to make sure that at the end of the month, there's enough coming in to support, the rent, the mortgage, the heating, the utilities, credit card bills, all that stuff. When a lender is looking at cash flow, a non-traditional lender, so SBA or otherwise, will be looking for a 1-to-1 cash flow ratio. All that means is that for every dollar spent, there's a dollar earned. Traditional banks and credit unions are very likely going to want to see something closer to 1 to 1.2, 1 to 1.25. So for every dollar going out, there's $1.25 coming in, roughly, because they're just not taking as much risk. That's what SBA loans and non-traditional lenders are here to do. If you are working with an SBA lender like Seed, cash flow is going to be global. So it's not just a matter of what the business makes and what the business spends, it's your whole financial picture. So you personally, your household, if you have secondary sources of income, whether it's from another job, a spouse or partner who's working, rental income, child support, whatever it is, all of that is going to go into it because we want to give you credit for the expenses and, the income that you have. So if you're chatting with a lender and, you're a startup, so you think that there is no cash flow right now because there's nothing coming in yet. That's not the case. We're going to look at things globally and use projections when we can. Credit, I think, is the C that everyone just assumes is the big factor when you go for small business financing. It's really not the case. Credit is just a part of it. And when we're talking about credit and credit scores, the score is not nearly as important as the credit history. So you pull your credit, your credit card will send you the number every month or so, and maybe it's a 680. If you have a 680 credit score, if person A has a 680 credit score and person B has a 680 credit score, the scores are the same. But let's say person A has a 680 credit score because their credit history isn't very long. They've never had a late payment. They just haven't had a credit card or accounts for much time. Maybe person B has a very long history of late payments, delinquencies, charge-offs. In those situations, that report and the history is much more important because those are the same scores for two very different borrowing practices. So that's what lenders really want to know when we ask for credit, whether it's traditional or non-traditional. What does your borrowing history look like? Because we want to make loans to people who do have good borrowing practices, repay their debts. They don't say, well, this is late because I just didn't feel like I should have to pay that. If you do have late payments, if there are charge-offs or are there blips in the history, we'll just ask for an explanation. Usually just looking at the credit report, we can kind of gauge whether something is a pattern or maybe there was a life event that affected the credit. If somebody has a great credit history and there's maybe 6 months of a lot of late payments, say between 2020 and 2021, we can say, well, maybe it was COVID, maybe they were out of work, maybe there was a life event, a medical situation, a divorce. A lot of things can negatively affect credit without actually reflecting you as a bad borrower. So when you're speaking with a lender about credit, do keep the score in mind, but be ready to explain any late payments or situations because most lenders will be willing to listen to the explanation. The third C is collateral, which I think is probably everybody's least favorite, but it is a part of the process. Collateral refers to how we secure our loans. As a non-traditional lender, an SBA lender, typically collateral is taken in the form of a home or a property. So if you're looking for a loan, we would take a position or a lien against either your primary residence, a rental property, a commercial property, depending on where the equity is. And that's basically how we would secure the loan. And if the loan didn't get paid, we would look to get repaid from the equity in that real estate. I always kind of say this as more of a disclaimer. Seed has been around for 40 years. Nobody's homeless because they got a loan with Seed. It's not what we're in the business to do at all. It's just kind of a skin in the game type thing that the SBA likes to see. With traditional banks and credit unions, collateral can be a little bit more flexible. They do take liens on homes sometimes, but there's also cash collateral. They can take a lien on equipment if it's available. And some banks will do things unsecured depending on the strength of the rest of the application. So when you hear collateral, don't feel like if you don't own a home, you're not able to get a loan, or if there's not enough equity, you're not able to get a loan. There are other options. For us, if you're a startup business and you don't own a home or there isn't enough equity in the home to use as collateral, we can do up to, for a startup, 10 to 15, for existing about 20,000 unsecured. If you're looking for something that's say 50,000 or more, there's also a program called the SBA 7A program. Sometimes it's called Community Advantage, that allows you to get an unsecured loan. The SBA acts as your co-signer in that situation and they guarantee the loan. But with collateral, that it's just a part of the conversation. It's as much a part of the conversation as cash flow and credit, and the other C's that we'll talk about. So the next one is contribution. If you are a startup or if you're an existing business already, you know that along the way, it's very likely you've put in some of your personal funds into the business. It's just the way it is, and that's fine because as lenders, if we can see that you've already contributed something, it kind of works in your favor. It shows that you do have skin in the game, that you clearly believe in the business enough to put your own money into it. And that's what we want to see. For someone within that first year of operations, let's say 6 months to a year, we would generally look for about 25%, a 25% contribution of what you're asking for. It's not a down payment. All it means is that if you are requesting a $100,000 loan with seed, let's say, we need to see that you have already put in about 25,000 into the business, in addition to the 100,000 that you're looking for, or that you have the capacity to do so. So we would check that on a personal financial statement, with, the value of equipment that you might have for the business, prepaid expenses, things like that. Your contribution is, like I said, a way of showing the lender that you're serious and that you do have skin in the game, and that, you believe that this business can be successful. Traditional banks look for about the same thing, 25% for a startup, and any existing business owners would just need to show, that they have that equity within the business. Character is a little bit different because those 4 C's that we just talked about, they're very much about the money situation. They're about the numbers. Character is very important, and it goes a long way, even though it doesn't have anything to do with what's coming in, what's going out. When we refer to character, we don't mean, do you volunteer at soup kitchens in your spare time? How many homeless puppies have you saved this year? Nothing like that. We mean character as it pertains to business ownership, specifically your business. Are you the right person for this business? Do you have industry experience? Have you put the time and effort into getting, a really robust business plan together? Are you making use of resources like the local chambers and other local organizations? When we look at character, what we want to see is that when we make the loan and it's maybe a 5, 6, 7-year term, whatever it is, that's somebody that we want to work with for that length of time. Character is, for non-traditional and traditional lenders, we say this all the time. It can be the thing that gets you the loan. If the cash flow, if the credit, collateral are just kind of teetering on the point of being bankable or not being bankable. So being, eligible for a loan and not being quite where we need things to be. Character can be the thing that makes a lender want to advocate for you, want to work with you, get you the money that your business needs. When working with a lender, being as open and honest and transparent as possible will do a lot for their character assessment. When I'm working with somebody and it's like pulling teeth, getting documents from them, or I feel like there's things that they aren't disclosing, and then we kind of find out about those things later when we pull credit or when we look at the financial statements. Maybe they said that their sales were one thing when they really weren't. That doesn't really, it makes it much more difficult on our end, to advocate to our loan review committee, to our executive director, to the SBA, that this person is somebody we want to work with, somebody who should be given the loan funds that they're asking for. When I'm working with somebody who is honest, who is taking advantage of a lot of different programs, who works with chambers, who has taken the time to put together projections and really put the work in, has the industry experience, it is so much easier to say their character is good. This is somebody that we would want to work with, want to give our loan funds to. The very last C is condition. So when I started teaching these workshops, condition, I would kind of refer to, the conditioning of the economy at the time that the loan is made. That's what condition means. And I would refer to businesses and industries that have certain trends. Not every business does well in a good economy. Not every business does poorly in a down economy. There are some businesses that really excel when things are a little bit rockier. But now I kind of just use COVID because we've all lived through that and we kind of know what that means for businesses and business owners. Obviously, the person who had a food truck January 1st, 2020, didn't know what was going to happen. So when we refer to condition, we're kind of just asking our borrowers to kind of at least let us know that they have a plan in place for how to survive the ebbs and flows of recessions, economic prosperity, things like that. And COVID especially has become a part of a lot of underwriting requirements, just telling us, if is your business affected by COVID, which could be capacity restrictions, it could be supply chain issues, it could be inflation, all things that have kind of happened as a result of the last 3 years. And if so, how do you plan to combat that? It doesn't mean that if you have a business that would be highly affected by another outbreak or by supply chain issues, we're not going to make a loan. It just means we want you to be prepared to kind of explain what your strategy is for getting through it. Any questions on any of the C's that we just talked about? I know it's a lot of information. And if not, that's okay. If you think of something as we move forward, that's fine. But what we can do now is we can take them one by one. Let me make sure this goes. And I believe everyone will get a copy of the PowerPoint afterwards, so that you'll have it as a reference if you want to use it, in asking for loans in the future. But so, that's kind of the overview. These slides are just going to go into detail for each C that we just talked about. So when we're talking about cash flow, that one, do I have a? Yes, absolutely. If you have questions after the fact and you want to email them over to me, that's perfectly fine. Making a list as you go is a good idea because it is very info heavy. All right. So we did talk about the 1-to-1 cash flow ratio, but I want to talk about, in terms of cash flow, what debt to income ratio is. And the explanation is kind of in the name, but when we're looking at it as lenders, how we kind of assess your debt to income ratio is we take for the previous fiscal year. So if I were looking at a loan project right now, 2022, we would take all the income that you had against all the debt that you have. So the total annual payments for credit cards, the annual payments for rent or mortgage, installment loans, so car payments, student loans, fun things like that. And how many times can your income cover that debt? That's what the debt to income ratio is looking to see. For us, if we are looking at a loan project, we probably want to see that it's 35% or lower DTI, the debt to income. So 35% or lower, we can generally work with. If it's higher than that, we might kind of want an explanation on, are you on payment plans? How do you plan to pay off this debt before the interest really gets out of control? That's something that a lender will ask for. You can kind of figure out your own debt to income ratio just by, like I said, looking at how many times your income can cover the debt. But I can also send over a template if anybody is interested, because we have templates for figuring that out. And I talked about us looking at things globally. So when we look at global cash flow, it kind of works in two ways. And if you're looking for financing, something to be just to prepare for is that a cosigner might be necessary. So if you are in your first year, 2 years of business, even if you're an existing business that's been operating 5-10 years, if you find that, the global cash flow is not going to support new debt from a business loan, a lender might say, well, is there someone who could co-sign? It could be a spouse, it could be a parent, it could be just a business partner, an unofficial business partner, maybe somebody who doesn't have ownership in the business necessarily, but is involved one way or another. And when I have those conversations regarding cash flow and regarding co-signers, a lot of times people aren't really, some people just really aren't willing to do that because they assume they're losing ownership in the business. The conversation that we end up having is just that having a co-signer who is guaranteeing the loan with you does not change the ownership status of the business. So if you're the 100% owner of the business and somebody signs, it doesn't mean that they have, a right to the business now. It's just that for the purposes of getting that loan, they're kind of a factor that's strengthening the request. So we would need it in that case. Co-signers, if you are married and you know that your spouse has poor credit or a lot of debt, co-signers can just as well hurt an application. So when chatting with lenders, just kind of be open and honest about that. Like I said, if you know that your spouse has poor credit, just confirm that up front. If you know that there's a lot of debt for a lot of joint debt, let them know, and a lender can kind of advise you the best way to go about it. We'll talk a little bit about business financials more towards the end, but very basically, when looking at cash flow, if you are a startup, so somebody within that first year of operation still, we'll look for projections for the next year. And if you're an existing business, we'll look for historical financials, so tax returns from the last 2 years, as well as interim financials. Because we're in March, it's kind of a strange time. Some people have their tax returns done, some people don't. If you were to go for financing tomorrow and you didn't have tax returns for 2022, we would just look for in-house numbers from January 1st, 2022, December 31st, 2022, and any interim numbers that you might have. But 2 months of the year doesn't always give us a good picture because the winter is slow for a lot of industries. So those in-house numbers from the previous fiscal year would be very helpful. All right. So with credit, we talked about assessing the borrower history, but in terms of actual hard and fast numbers, for a non-traditional lender, 600 is generally the bottom line credit score. So if you have 600, if your score is 600 or higher, that's something that we can work with. If you know it's a little bit lower, there are resources that can help. And I don't mean, situations where you give somebody your social security number and then you kind of just hope for the best to see if they're going to repair your credit. There's an organization out of Plainville, and the chamber may even be connected with them. It's called the American Credit Counseling Service, ACCS. They're a United Way partner, so they're a nonprofit. The credit support they give is confidential. It's a free service. I refer quite a few people over to them. If you're looking to raise the score and you don't want to take a risk by, paying somebody to raise the score, that's a great option. If anybody is looking for the contacts, I can send that over to Chris after today's workshop, and she can send it out to you all. The woman I work with over at the American Credit Counseling Service is Betty Howard. So it is a person that you'll talk to on the other end of the phone. And like I said, a lot of our borrowers have used them. On the higher end, if you have a 680 credit score, that's generally for a non-traditional, for a traditional lender, so a bank or a credit union, 680 is where they want to see the score. If you're above 680, it's generally viable. Lack of credit, poor versus poor payment history, I touched on a bit. But what the takeaway here is, if you have a poor payment history, that's where credit counseling can really help you, because they can kind of help you get things settled, make sure that there's not, losses, things like that. A lack of credit is a little bit easier to deal with. Lack of credit could be a short, maybe people just like working with cash. Maybe you're not a fan of debt, so you really don't want to have too many credit cards. You don't want to have much credit. It's important to build credit as a business owner, but that doesn't mean going into a ton of debt. It could be a credit card you take out strictly for business purchases. Maybe you're just charging $25 a month on it, something very minimal. Over time, that will build up your score and just show a lender that you do have a history of paying things on time, of not taking on, not being highly leveraged, not taking on a huge amount of debt. All that can go a long way. Lack of credit is less scary to a lender than a poor payment history, but both have their risks, but both also, with the right explanations, can be mitigated when you're going through the loan process. If you've had a bankruptcy in the past, that can obviously affect credit. For non-traditional lenders like Seed or like SBA, the bankruptcy has to have been discharged for at least 5 years before going for financing. That's generally true for banks and credit unions. But if you have had a bankruptcy in the last, 3-4 years, just ask ahead of time before they're running your credit, before you're going through the trouble of submitting an application. Ask what their policy is if you think that will affect you. And that's advice I give a lot. If you are not really sure if you are going to qualify for financing with a bank, with a credit union, with Seed, with other SBA lenders, pick up the phone first. I always have that introductory call because I don't want somebody to go through the process and the trouble of putting together a loan application package, having their credit run if ultimately, we weren't able to do it in the first place. Collateral, we have let me see, do you have a question? So the question I have, how does credit counseling services compare with places like national debt resolution, debt consolidation, places that you pay a fee with? So the American Credit Counseling Service, they do not have fees, as far as I'm aware. Their services are free to use, and they're really, they're going to work one-on-one with you. It's not going to be something where they take care of the credit for you. It's going to be kind of a team effort. They offer counseling and coaching, but they can't get rid of the debt for you. For things like that, if you felt like that was going to be necessary, you would have to look into other options, but no fee associated with the American Credit Counseling Service. And thank you for your question. All right, so with collateral, like I said, we could look at personal or commercial properties. If there isn't a commercial property, we can look at the business assets and equipment. That all is, kind of true for non-traditional and traditional. But like I said, if you don't have collateral, if you don't own a home, these are kind of the guidelines that we look for. We look for an outside guarantor, family member, spouse, business partner, unofficial business partner. We'll look for, doing an unsecured loan up to a certain amount. 10 to 15,000 for a startup, probably up to 20,000 for an existing, or we can look at the SBA 7A guarantee. When you're speaking with your bank, maybe it's the bank you do your personal banking with, maybe it's a business bank account that you have. When you're chatting with them, always ask if they offer the community advantage loans. It's not something that bankers are necessarily going to think about because it is an SBA program, but a lot of banks in the area work with those programs. And if you are chatting with banks who are members of the chamber, it's very likely that they'll have information on that. Because if they work with the chamber, they're small business oriented, obviously. So they would very likely be able to tell you about the community advantage loans. Okay. Contribution, like I said, the lender is not going to necessarily provide 100% of the financing for the project. If you are asking for 50,000 or say 100,000, keep it easy. If you're asking for 100,000, to get the 100,000 in loan funds, we want to see that 25% contribution has been made, or that for an existing business owner, there's already money that's been invested into the business that can kind of add up to that 25%. It's more a skin in the game type thing than anything, but it also does kind of just show that it kind of solidifies you as a business owner, that it's more than just a hobby. It is a business that you're going to stick around and run. It's not something that you're going to just kind of get the loan funds for, build up and sell immediately. For SBA lenders like Seed, we're looking to make loans so that businesses can grow and create jobs. That's our mission. We want to see that there's job creation, that there's, strong businesses in a community just strengthen the towns and cities as a whole. So that's our goal. If we know that, somebody has not really put a lot of money into business, that they're not really in it for the long haul, that they don't have much skin in the game, how closely does that business align with our mission? That's something that we would have to ask ourselves. So with contribution, make sure you're giving yourself credit for everything. And when I say giving yourself credit, I know it sounds silly, but even if you've purchased things a year ago, a year and a half ago, save your invoices, save your receipts, scan your receipts because they do fade over time. We can probably we can certainly look at up to a year of expenses, and generally like 18 months is where we kind of cut it off. But this is very important. If you find that the reason you need financing, the reason you're looking for loan funds is because of, for debt consolidation. Let's say when you did get the business started or just over time, you took out a lot of high interest debt and you want us to consolidate that and pay it off at a lower rate. Invoices, receipts, a record of those expenses, how the debt did kind of get to be where it is very important. Because if we can't show the history of that, then it's difficult for us to consolidate the debt. In character, there's not much more to say about it because it is kind of just, it's not something you show on a balance sheet, but Whereas the other C's of credit are asking, can you pay us back? Have you paid, in the past? Character is just kind of a matter of, will you pay? Are you the type of person that leaves debts unsettled, or are you somebody that works hard to make sure that at the end of the month, more has come in than what's gone out? And if it hasn't, let's say it's been a slow month, let's say you're going through a tough time, are you going to just tell us and let us know? That's fine. Businesses have seasonality. Businesses go through tough times. We have, for our, Seed and other SBA lenders and every bank and credit union, there are servicing departments that are there to kind of help you once you've already gotten the loan funds. If for any reason you can't make a payment on time, if you can't make a payment, the best practice is just to pick up the phone, call the lender, call the creditor, and let them know. If they know ahead of time, when the payment is due and it doesn't come in, it's not a surprise, but they can also work with you, maybe put you on a different payment plan that works with the seasonality of your business, or just talk about, different options. The last thing you want to do is just kind of not communicate and let things go unpaid over time, and then have, a letter at that point saying, this is what you owe, we haven't heard from you, etc. In condition, I'm not going to go into that again. Like I said, when I used to teach these workshops, there was a lot more to say. But with COVID, everybody, I think, now has a good idea on how external factors can really affect your business. They have nothing to do with, your ability as a business owner to bring in sales. Sometimes things just happen. So as long as you can show a lender that you have a strategy for dealing with those things, that's perfectly fine. So that's, things, what lenders look for, things that lenders will want to know in terms of the financials. I want to talk more about the business plan now, because a business plan is, well, it's required for startup businesses. It's also incredibly helpful, even if you are someone who's been in business 10 years and you know the business in and out. A business plan can constantly evolve and grow with your business. And it's a great way to make sure that you're staying on track and hitting your goals. If you're not using it as an operation guide, if you're, way past the startup phase, you can use it as a roadmap. You can use it as a goal tracker. The business plan will kind of force you to look at aspects of the business that you might not have considered before getting them down on paper. When you're presenting a business plan as, a pitch or a slide deck, whatever it is, to a lender, to a business advisor, just to somebody that you want them to learn more about the business, these are the items that it should include. Statement of purpose or mission statement. So why do you do what you do? What is the mission of your business? Maybe it's to bring in sales. Maybe it's to fill a community need that isn't being filled. I had a woman she had a gift shop that she opened during COVID, and her mission was really just to kind of spread positivity, because it was a tough time for a lot of people. Obviously that evolved into, well, now she can, hire more people. She could create jobs in her community, but the mission statement can be as simple as that. Table of contents to keep things organized, a business description, of course, and I'll explain the components that you want to include in that, marketing plan, and a financial plan. So when we're talking about business description, these are the bullets that you want to hit. However you format it is fine. If you do paragraphs, if you do bullets, whatever works for you. There's no right or wrong way to format a business plan, as long as it's neat and easy to read with logical transitions. All of that's just fine. You want to say in the business description the type of business that you operate or the industry. Is it resale? Is it distribution, wholesale? Are you mainly working business to business? Are you business to consumer? Those things. You might find that you have a couple different industries or a couple different, maybe some of your clients are residential, maybe some of them are commercial, whatever it is. The status of the business, this is important to know, because when you are submitting a business plan for a loan proposal, status is going to change depending on who you ask. For SBA, for Seed Corporation, a startup business is anyone within that first 6 months to a year. That's what we consider startup. Once you're past that year, those 6 months, depending on how their operations are going, we would consider you existing. A lot of banks and credit unions will look for 2 to 3 years of tax returns before considering you an existing business. The reason this is important to remember is because if you are on a bank's website and it says that they are not providing loans to startup businesses, or if you've heard someone say we don't provide loans to startup businesses and you've had your business 2 years, so you're thinking you're not a startup, you're an existing. In the eyes of the bank, it could very well be that you are still a startup. So again, to go through the trouble of submitting the documents, having a credit pull, which is going to bring the credit score down a few points, not worth your time. Always ask ahead of time what they are looking for an existing business. If it's 2 to 3 years of tax returns and you only have 1 year of tax returns so far, it's a good idea to look into other options at that point. What's the legal structure of your business? It could be a sole proprietorship. It could be an S Corp, a C Corp, an LLC. A lender will never be able to advise you on how to legally structure the business, but they will want to know how it's legally structured because the structure will play a role in what documents we would need to close a loan. You know, a sole proprietorship only has to register with their town or city. A corporation will have to register at the state level. So we want to make sure that everything's been done properly. If you've been operating as a sole proprietorship and you're thinking now is a logical point to switch over to a corporation for whatever reason, you know, it could be that maybe as the business has grown, there's a little bit more liability to what you do, and a corporation will protect you from that liability. If you're looking to do that, just let the lender know ahead of time that that is in your plan so that we can account for that. Location and hours of operation, of course, very important. The market description is going to include information about your target market or markets, because it's very likely you have more than one. So who you're selling to, as well as a description of your competition. They are 2 separate bullets, but I kind of lump them together because dealing with the competition is as much a part of marketing as attracting new and existing customers. When we're talking about describing your competition, I would break it up into 2 categories. You want to be able to explain your indirect and your direct competitors. Does anyone know the difference between an indirect and direct competitor? That's okay if you don't. Let's see. Nope. So a lot of people assume a direct competitor is local and an indirect competitor is somebody far away. And that's not actually the case, although, you know, it could be. A direct competitor is anyone offering exactly what you're offering. So the same product or the same service. A good example is Coke versus Pepsi, right? People will argue the fact, but I'm not a soda drinker, so I don't really have a horse in the race. It's the same drink, right? Just 2 different companies selling the same drink. Coke versus Pepsi is a direct competitor. Indirect competition is anyone offering an alternative to your product or service. So someone who could take sales away from you, not by selling, you know, the same thing at a lower price or in a better way, but rather selling something, whether that is, you know, a service or a product that makes your product or service obsolete or just not as attractive an option. Soda versus coffee is perfect. Yes. Soda versus coffee, Coke versus Gatorade, or, you know, just kind of people wanting to be a little healthier. If somebody is not interested in drinking something sugary and syrupy, you would really, as the CEO of Coke, which I'm assuming none of us here are, you would really have to work hard to gain the favor of that group of people. And it's not always worth it. You know, there's an 80-20 rule in screen printing versus embroidery is a perfect example. Yes. Handmade things versus, you know, graphic design things. Perfect. What I was going to say is there's that 80-20 rule in marketing where 80% of your profits come from 20% of your customers, right? There's a lot of 80-20 rules, but that's the one that we use when we're talking about marketing. It's in your best interest and you're going to have the best return on your investment when you're trying to reach people who already have a want or a need for your business. The people who don't, the people who are maybe going to make, you know, 1 purchase a year or are just not super into whatever it is that you offer, not worth your time and budget usually. You know, it doesn't hurt to try to gain new clientele, But that loyal customer base is really, the one that's going to count the most and bring in the most sales and give you the best return on whatever you're spending on your marketing budget. And last in the business description, we have management and personnel. So whether your business plan is for a lender or for, an advisor, or just kind of for your own operations, you want to be able to account within the plan for the management and personnel needs. It could be that, you're really good at what you do. You're really good at operating your business, but maybe there's an aspect of the business that you just don't have the skill set for. It could be bookkeeping. A lot of the times it is accounting and numbers, things like that. Unless you are an accountant, we find that a lot of people have trouble with that, that part of owning a business. So maybe you bring somebody in who can do that, who can, pick up the slack there, mitigate that weakness. Maybe it's that you just need a team of people to be able to serve all your customers, serve the orders that you're getting. If that's the case, then you need people. How many people do you absolutely need? How many can you afford to pay? And what type of employees do you want? Do you need people who come in with certain degrees and certain certifications and trainings under their belt already? Or are you looking to train them when they join your team? And if you are looking to train them, what's the cost of that training? What's the monetary cost of the training? And what's the time cost? How long does somebody need to work with you before they can really start contributing, before they really have everything kind of down and they know how you want the business run? The financial part of the business plan is very important. The financial part is not really, it's slightly, related to the 6 C's of credit that we talk about, but the financial information in the business plan is strictly business. So whereas a lot of the C's were personal and business and how they interact with each other, this is only for your business. So when you're looking for financing, what are the sources and uses of the funds? How much of it is going to come from banks, from lenders, and how are the funds going to be used? How much have you injected yourself? Do you have any investors? You want to disclose that in the business plan. If you do have any outside investors who are entitled to any portion of the business, maybe it's 1%, 2%, small things like that. A lender will typically only need the financial information and the guarantee of business owners with 20% or more ownership in a company. But they would still want to know how the remaining ownership is broken down. So if you own 90% of your company and that remaining 10% is available for shareholders, or for, maybe you're going to hire people, and as you hire them, they get a certain stake in the business, you'll need to just let us know. And including estimates and quotes whenever you can is very helpful. It's helpful in a couple ways. If you're looking to purchase equipment with a small business loan, or just purchase equipment down the line, you want to make sure that there's, enough money to make the purchase if you're not getting financing. If you are getting financing, you'll want to show the lender that, yes, this is what it costs. These are the associated fees, taxes, shipping, handling, all that stuff. But it's also important when you're figuring out, at the end of the year, depreciation, things like that. Ideally, an accountant would help you with that. But if you've made a purchase within the year for, let's say, a $50,000 business vehicle, we'll say, how is that depreciating over the year? So, if something happened and you had to replace that, what is that going to cost? And if you have, if you're using this business plan for a financial proposal and you've been declined by other institutions, that's not something that you want to kind of keep to yourself, assuming it'll hurt the application, because it won't, not for SBA. We need to see that you have spoken with other lenders before we can really start on anything 20,000 or more. Doesn't mean, you need a decline. Doesn't mean you have to have your credit run, because we don't want to see that happening unnecessarily. It just means that if you've spoken with a bank or credit union and the answer was that, no, at this point, we can't provide financing, just let us know and include reasons for the decline. Reasons, as we talked about with the 6 C's, the reasons are going to differ institution to institution. What is a decline for seed might not be a decline for somebody else. And what is a decline for a bank might not be a decline for seed. Other financial things that you will be asked to present for a loan proposal would be a personal financial statement. A personal financial statement is essentially just a balance sheet for you. So whereas your business balance sheet shows assets and liabilities of the business, your personal financial statement is going to show everything you own versus everything you owe. Things you own would be, money in your savings account, real estate, cars, with, the resale value, life insurance policies, personal property like jewelry, electronics, furniture, significant, amounts, obviously. The total of everything you own versus everything you owe. So car payments, student loans, mortgages, unpaid taxes, things like that. We would basically take those two numbers, figure out the difference, and find your personal worth. That's what we would be using the personal financial statement for. For existing businesses, the year-to-date balance sheet and income statement will be important. So if I were doing a loan for somebody right now on March 14th, I would ask for a balance sheet as of February 28th and an income statement January 1st to February 28th of this year. Like I said, it wouldn't tell us much, so I'd really want to see the 2022 numbers, but we would ask for it all the same. 2 years or, however many years of federal tax returns that you have for the business, and a list of business obligations. A lot of people will ask how important business credit is. So for SBA lending, business credit is not super important. There are some programs that we do pull business credit for, but generally for microloans and small loans, we're not going to ask for the credit score for your business. We will ask you to disclose business obligations. So just what debt that the business might have that wouldn't show up on your personal credit report. If you've taken out, for example, if you've taken a loan with Seed, if you have a PPP loan that you're still paying off or an EIDL, that's where you would put that. So we just know if there are other expenses that aren't on the income statement, that aren't on your personal credit report, things that we need to account for. For startups, the projected income statement, of course. And as I said, we have templates that can be really helpful if you find that that's something you're interested in. On our website, if you go to seedcorp.com, there is a resources tab up at the top that has a projected income statement template, a balance sheet template, a full business plan template that's very easy question and answer format. So, you can kind of get through it pretty quickly. And then the 12-month cash flow projection. So for anyone who hasn't kind of really prepared them on your own, the projected income statement is basically year one. How much are you going to bring in sales for that year? What are the expenses? What's your net profit for the year? The 12-month cash flow projection is also for that first year, but what you don't want to do is take the numbers on your projected income statement, so the number of sales, the number of expenses, and divide that by 12, because that's not realistic. If you're looking to project, month by month what you're going to bring in, if you're still kind of ramping up, it makes sense for things to start a little bit more slowly and kind of build as the year goes on. If you have a really stark seasonality to your business, maybe you make most of your sales around the holidays, maybe most of your sales are in the summer months. Obviously, being located in Southeastern Mass, there is a lot of summer seasonality because tourists and things like that. So that's what you want to do in the 12-month cash flow. You want to just show month to month how you get to those year-end numbers. And then a day one balance sheet is basically just, like the name suggests, on day one, what does your business have to its name and what does it owe on day one? It might, the things that you might own on day one would be working capital. Maybe you've contributed $5,000 of your own money as working capital. If you've purchased any furniture, the value of that furniture. The things you owe could be term loans, business loans. It could be the balance on your business credit card if you have one, a few different things. The balance sheet is a little bit trickier. Don't feel like, if you're submitting a loan application with Seed or with a bank, don't feel like it has to be absolutely perfect. You can submit one and the lender can kind of ask questions to get to the true numbers, make adjustments. We make adjustments on a lot of our financials that we get in after talking with the business owners. If somebody is, telling me that this is what the business owns on day one, but they've kind of not accounted for certain things because maybe they just didn't think to, I can add those back in.
Yeah.
And these are just some final reminders. You know, if you are looking to get some business financing, the more the lender knows about you and your business, the better we can assist you. So be honest, you know, be transparent, give them as much information as they ask for and as they need. And of course, neatness and conciseness count. And this is kind of something that gets overlooked a lot of the time. But when you are going for financing, you want to give a good impression of you as a business owner and of the business. So if you're providing documents, make sure they're neat, make sure that they have been reviewed, that, you know, you kind of did them with care. You didn't just scribble a bunch of numbers onto a notebook page. I have received notebook pages as, you know, as documents for loan applications. You want to be professional and you want to give something that's presentable. If we can't read it, if we can't understand it, it's just kind of going to lengthen the process, because we not only have felt like maybe you didn't put the time and effort into getting the documents together, but we'll also just have a lot of follow-up questions if it's not clear what the statements are showing. So that's, you know, that's what I have. And it looks like we do have some time for questions. If anybody does have any, I'm happy to go over anything that we talked about. And if not, my contact information is here. I know a lot of the things, especially when we're talking about financing and personal finances, business finances, a lot of those things and questions that might come up are maybe ones that you would want to talk about one-on-one. So that's fine. Anybody who is interested can call me at this number. That's my extension, or you can email me, whatever is easiest, and we can talk in detail about your business, what you're looking for, even if you're not looking for financing. We do a lot of calls that are strictly about, you know, resources and just being prepared. We're really connected, as is the chamber, to a lot of free and confidential business mentoring people in the area, like John Gigat, who I think some of you met at the member orientation, SBDC, CWE. We can connect you with all of those guys. So if there aren't any questions, Chris, I'll turn it back over to you.
Jessica, there was another question in the chat about how long it takes to be approved.
Perfect. Great question. So for us with SBA, usually I tell people that once I have a complete application in, expect about 4 to 6 weeks, start to finish. In that first week or first 2 weeks, you know, if there are follow-up questions, I can usually tell you at that point if it's not something that can move forward, so that you're not waiting around. You can at that point go and look into other options. But if it does look strong after that initial review, it goes into a second review with our lending team leader, with our executive director, who then can approve it to go to underwriting, which can take another week. And then it's a matter of just closing, you know, getting all the documents in that we need. So 4 to 6 weeks is pretty typical.
That's all the questions. Oh, wait, one more. How do you access your business credit? And when applying for a business loan, does it always show up on your credit report under personal social?
Great question. So as I said, we don't really have any interest in business credit. How you would access it, I'm actually not familiar with, but Center for Women in Enterprise holds a workshop monthly on business credit. It's actually a 3-part workshop where they go over a lot of those things. So I can actually give you the instructor's contact who teaches it. She could probably give you more guidance on that. When we're looking at, you know, does business loan show up on your credit report? Sometimes yes, and sometimes no. Seed Corporation doesn't report to the credit bureaus. So if you were to take a loan with Seed, it would not show up on your personal credit. But some business loans are, they will show up depending. Normally, if a loan is taken out in your personal name for business purposes, that'll be on, because your social security number would have been used to get it. That'll be on the report. If you're working with a bank or a credit union, very unlikely that that loan would show up on, because banks and credit unions are going to make loans to businesses. Whereas a lot of, you know, online lenders, credit cards will make the loan to the person, even if it's for business expenses. So what I always tell people, if you have business loans and you're not sure if it's on your personal report, just disclose it as business debt on that list of obligations that the banker asks for. If we'll cross-reference, and if we see that there is an overlap, we'll only count it once. so that you're not being double counted. It's not, working against you.
Another question in the chat, when buying a house, when buying a house, it wouldn't show as a personal debt.
It does. If you own a home, if you have a mortgage, that will show up on your personal report. And if you own the home with somebody, they will likely have to guarantee as well, because if we're using it as collateral, then unfortunately, you wouldn't be able to use a home that you owned with somebody else without their permission. Other way around.
Oh, yeah.
I don't believe, no, I don't think the home would show up on a business credit report.
Any other questions? Oh, if I got the loan first, then that's, oh yeah, okay, you answered that already, I think. Okay. All right. Thanks, everybody. Jessica, always so informative. Thank you so much for sharing this information. It's a fantastic organization. wish more people knew about it, pursued it, explored it, all of those things. As with, a SCORE as well. I know you promoted SCORE. We do here at the Chamber. Please, if you are looking for a SCORE mentor, please feel free to reach out to me or Jessica, but the Chambers, that's what we're here for. Can get you connected with a SCORE counselor, and usually we'll meet right here in our office or virtually, whatever is most convenient. So thank you so much again. And we'll make sure that we can get these slides out to you folks and the other information that you requested. So
Yeah, thank you for having me.
Everybody.
Thank you, everybody.
Stay dry.